This week we had a wave of earnings results, and so I wrote about a slew of those. Last Sunday, I started out by talking about the sentiment that we're hearing from oilfield services companies coming out of the most recent round of earning results. And that sentiment is incredibly optimistic. There are a lot of stories from Halliburton, Baker Hughes, Schlumberger, and the rest about how supply and demand in oilfield services are really striking a pretty favorable balance, that these oilfield service companies have some pricing power, and they're now able to generate cash and profits that they historically have not been able to achieve for quite some time to this point. And some of them have even talked about the balance between the returns that the oilfield services side is getting versus what the operators themselves are getting. And in their opinion, it's a healthy balance. So I kicked off this week with last Sunday talking about that sentiment that we're seeing across a lot of the commentary that we get from these oilfield services companies. My next post was on Monday about Range Resources, and specifically I was looking at estimating their break-even natural gas prices given their most recent set of earnings results. And we see that for Range, they require gas prices anywhere between $1.50 and $2 per MCF to break even on an operating profit basis. So what that means is, even with natural gas prices as low as they are today, still sort of between the $2 and $2.50 range, that is enough for Range Resources to generate operating profits the way that investors would demand, the way the management team expects. And so these prices aren't necessarily the healthiest levels that natural gas focused producers could be at, but still for the most cost effective producers, these prices are not at unsustainably low levels. My next post was about Halliburton. We got their new results this week, and specifically I used their results to talk about this notion of operating leverage. Here, what that means is how effectively is any company translating an incremental dollar of revenue into an incremental dollar of profit. And what I showed was that Halliburton is basically the best in the oilfield services game, at least amongst the big three, at creating incremental profit dollars from incremental revenue. So I use that post to talk a little bit about that as a financial metric, what that means, how to compare across, some more as help for folks that are doing this sort of analysis on their own. Next up was NexTier Energy. And their management team talked a lot about their cash generation and how healthy it is today. What I did was went back and looked at NexTier's cash generation since the beginning of 2018. And sure enough, we see what the management team is talking about, that in the last 4 quarters, NexTier generated much more free cash flow than it did in the 4 years prior to that. So there is a sizable change here. And what gets interesting is NexTier's talk about how this free cash flow profile should expand even further from here. So the real questions become, how much further does it expand? How quickly does it take to get there? How long does it last there? So a pretty interesting bit of commentary and subsequent analysis coming out of NexTier. My next post was about NextEra Energy, and this is the renewable energy giant. We got new earnings results from them, and I pulled out some of their adjusted earnings results to take a look at how expensive is NextEra Energy today in terms of its stock price relative to the earnings that it's generating. I compared some of those metrics to what we see from U.S. Treasuries, which are sort of the lowest risk assets that the investment community typically looks at. So you take more risk with NextEra, you expect to get more return, to generate more earnings from that than you would from generating in Treasuries. So I made that whole comparison and looked through what kind of valuation does NextEra have today? Is it attractive? Long story short, it was not very attractive in the back half of 2022 by these metrics, but today it's getting back to about as attractive as it was in the first half of 2022. So then there's, of course, some decisions to be made around if you find that kind of premium sufficient, then today looks good for you. If you require more because of the increased risk that's coming from, say, recessions and other macroeconomic headwinds, then you might want to wait until you see a better premium before you jump into NextEra. I closed this week by writing about Valero. We got their results on Wednesday, I believe. I wrote about them on Friday. They had an interesting bit in their earnings call about their businesses in California. And we know that California has just signed a bill that allows the California Energy Commission to potentially set profitability caps for refiners in the state. And the Valero management team was asked about this on the earnings call. The CEO very directly said, our California business does not generate much in the way of ongoing earnings. We view that business as being an option around those times that profit really does spike in California, and that makes it worth all the rest of the time where the returns aren't all that great. So if California sets a cap there, he says, we have to reimagine or rethink how we invest and how we play in that business. What I wrote about was how pretty stark that was in terms of earnings call commentary. You don't hear even sort of getting toward that level of explicit commentary when it comes to earnings calls. But this is how you play politics, that there's this natural tension between governments and business management teams. And so that call was just an interesting demonstration of the push and pull around trying to negotiate for a preferred regulatory environment in California. So that was the recap of my posts this week. As always, I produce a weekly newsletter that I send out on Saturdays that has links to and summaries of each of the notes that I put on LinkedIn. So that way you don't have to worry about the LinkedIn feed ensuring that you get each post that I produce. You can just find a list of them at the end of each week. Also in my newsletter, I include an energy-related anecdote, insight, or observation. And I make sure that it's something that's unique to the newsletter. I don't share it elsewhere, so that even if you did see all of my LinkedIn research over the week, when you get the newsletter, there's at least going to be something new for you in there. And this week I wrote about natural gas prices and the future of natural gas prices, what we might expect to see going forward in that domain. So thanks a bunch for reading. As always, I appreciate it, and we will talk soon.